Hello, we'll give it one more minute to let folks log in, but please do feel free to introduce yourself in the chat in the meantime. Welcome. All right. Hello, everyone. I see people welcoming each other and greeting each other in the chat. That is great. We are so glad you're here for our webinar, Shared Equity Conversions, Stabilizing Homeownership and Creating Community Assets. I'm going to go over some brief things for our welcome, including our agenda. Today, we're going to have some welcomes and introductions, and then we'll highlight the context that we're working in. We'll be delivering a framework for addressing homeowner distress. We'll talk about some really specific scenarios to dig a little deeper. And then we'll hear from some people who are doing this work right now. We're learning about what they've learned and hearing about emerging opportunities. We'll definitely share some resources as we wrap things up. And then hopefully you all caught in your reminder emails that we're actually going to have a little bit of extra time today. Our agenda was so packed, we wanted to be sure to be able to get to some Q&A. So we'll be staying on for 15 more minutes in order to answer Q&A. So first, I want to thank NeighborWorks America for sponsoring this event. NeighborWorks' mission is to create opportunities for people to live in affordable homes, improve their lives, and strengthen their communities. They're really doing amazing work with their shared equity housing initiative, including sponsoring this event. And I'm excited that Shanti will be speaking a little bit more about their work and their initiative later today. And just a reminder, we're hosting Grounded Solutions Network is a national membership-based nonprofit organization where we're working to cultivate communities with equitable, inclusive, and rich in opportunity. We want to advance affordable housing that is racially inclusive and that lasts for generations. And for a little bit of those introductions I promised, I forgot I am Jenny Gaynor. I'm Capacity Building Manager at Grounded Solutions Network, and I'll be hosting today, helping out. Our main speakers are going to be Beth Source, our Director of Capacity Building, as well as Shanti Abedin, Director of Shared Equity Housing at NeighborWorks. I did include the rest of our capacity building team at Grounded Solutions Network, Baradillo, Jerusha, myself, Jason, and Matt. We will all be active in the chat today, most likely answering questions, answering technical questions, anything that you need. We'll be out there trying to give some quick responses wherever possible. So thank you so much for joining us. And I have one more thing to do before I turn it over to our speakers, and that is get us a little bit of practice engaging in our polls, because we are not asking you to just sit and listen. We are definitely asking you to engage in the chat, in the polls, and in the opportunity for Q&A a little bit later. So I'm going to ask Baradillo to launch our poll. We want to know who is in the room. Give us some quick information about who you are and what you are doing. So I'm going to have us practice. I'm asking, please do answer. It's great to know who's here, and it's great to get this practice in. And it also helps us if you're having trouble with the polls, it doesn't pop up. Usually you can see it at the bottom of your screen. There'll be a polls option and you can click on that, it'll pop up. If you still don't see it, feel free to type in the chat. It's definitely a great way to share who you are and what you're doing here. So I'll give us maybe another 30 seconds to answer. Oh no, it sounds like the poll is blocking my screen share. So there we go. Lessons learned, that's why we're practicing. And so in the meantime, I will also note that the closed captioning should be turned on. We have the Zoom auto function. It's another thing that you could turn on and off by toggling at those controls towards the bottom of your webinar Zoom screen. All right, awesome. I'm going to wrap up our poll. Thank you so much. We got 85% of you responding. Only a third of you indicated you're excited to be here today. I hope we will get up to 100% by the end of our webinar today, but this is just a quick example. You should be able to see the results, and we're going to share and engage in some of these polls a little bit later today. So thank you all. Definitely, again, feel free to chat, and we will try to get any answers. But now I'm excited to turn it over to Beth for the main presentation. Thanks.
Great. Thank you, Jenny. So we've been talking about hosting this webinar for a really long time. I know that stabilizing market rent homeowners through a shared equity conversion has been a hot topic amongst members. And it's something that we as staff at Grounded Solution have prioritized and been working on for more than a year. I think we've all come a really long way in how we think about homeownership stabilization. And I'm really hoping that this is one of a series of conversations that we can all have about it. Even though we're more than a year into this pandemic, there is still a whole lot that we don't know about what's going on with homeowners who are currently in mortgage forbearance and or delinquent in their mortgages. But there are some things that we do know. Um, so, oh, hold on. I'm going to pause for a second. I'm still seeing the poll on the slide. Should I close that? Maybe it's just me. Maybe that was just me. I did it. Okay. As we know that 2.6 million homeowners who are past due on their mortgages, of that total number, over half of them are people of color. And we know that forced sales resulting from the pandemic will likely further widen the homeownership and wealth gap between Black and Latino households and white households in America. And as Julie Guggen put it so well to the Wall Street Journal, if we don't get out in front of homeowners who are at risk, it will set homeownership in communities of color back a full generation. So we know that the stakes are really, really high right now, especially for people and communities of color. But at the same time, we also have unprecedented federal resources coming our way from a supportive administration. And just last week, there were changes in leadership at the Federal Housing Finance Agency that make me hopeful. And we still have all of the knowledge and skills that we collectively built in the last mortgage crisis that I see already being deployed right now. So all of that to say is that it feels like we're in this moment in time where an innovative program like a shared equity conversion could both be needed more than ever, but it could be more possible than ever before. And so that's what I'd like to share today is this framework for addressing homeowner distress that we've developed that centers around a shared equity conversion. So in a shared equity conversion, a market rate homeowner chooses to become part of a shared equity program. And in return for that reduced monthly payment to make that home affordable to them, the homeowner agrees to resale restrictions that will ensure that the home remains permanently affordable for future generations. So the benefits of this strategy could really extend far beyond this one particular homeowner's property line, right? For that homeowner, they get to retain all of the equity that they've already accrued in their home pre-conversion and remain in their home at an affordable rate to them. The properties will remain occupied, and with lasting affordability, we can really create that community asset that is going to be there in the long term. The city can increase their overall amount of affordable housing that they're able to offer and reduce homelessness. The shared equity program can grow their portfolio of homes and better meet their mission, and lenders can avoid expensive foreclosures, right? It really is a win-win-win type of intervention. So the first thing that we do under this framework is identify what is causing homeowner distress. We tease apart those different elements. It could be an unaffordable mortgage payment, likely resulting from some kind of catastrophic life event. It could be unaffordable taxes or significant deferred maintenance that could threaten the health and safety of the homeowner and result in code enforcement liens. The homeowner could have fallen victim to a scam that has destabilized them, or most likely what we tend to see is that homeowners in distress are experiencing multiple types of distress at the same time. Once we've then identified the type of distress that's occurring, we can start to identify the type of levers to pull in order to intervene. So some of the levers that we have been exploring at Grounded Solutions are the ability to reduce a homeowner's unpaid principal balance and adjust other terms of their loan, such as the interest rate and the term of the loan. We've been talking and looking at the savings and benefits associated with reducing a homeowner's taxation rate, if that's available locally to shared equity homeowners, um, as well as addressing critical home repairs. We've also talked about the need to address and resolve other types of debts that can be destabilizing, like excessive credit card debt, medical debt, school loans, all of those things that also can disrupt a homeowner's life. But I want to be clear that what we're not talking about is asking a homeowner to give up any of the equity that they've already earned in their home. That's not a lever that gets pulled in a shared equity conversion. So we've modeled out, and some of you on this call have piloted several different types of interventions that I've distilled into 6 generalized steps. We're going to walk through each one, and then I'll return to this pathway at the end so that you can again see it all put together. Step one is that a homeowner reaches out and requests assistance. And we know that shared equity homeownership can be difficult to understand on a good day. But when you're working with people who are in distress, it can be really difficult to understand. So, how organizations talk about a shared equity conversion matters a lot, as does building really strong relationships with entities, organizations, and individuals that homeowners already trust, like housing counselors and legal aid attorneys, so that they can be your trusted messenger in working with those homeowners. Once a homeowner is aware of the opportunity and expresses interest, the very next thing that they should do is meet with a homeownership counselor who can help them learn about and evaluate all of the options that are available to them. That counselor can also provide basic education to the homeowner and help them consider the short-term implications of a shared equity conversion, which could be a further reduced monthly payment, with the long-term implications of foregoing some appreciation on their home, future appreciation on their home. Uh, and then if the homeowner is still interested in learning more, they submit an application to the shared equity program and go through the typical orientation process. And so the shared equity program is going to do what they usually do. They're going to screen that homeowner and their home to make sure that they both understand the deal and are eligible. So they're looking to make sure that they meet their program, funder, and potentially, in this case, lender eligibility criteria. And then specific to a shared equity conversion, they're going to make sure that whatever the program can offer provides relief to the homeowner and that they are able to make that home permanently affordable going forward. And so the way that that home is made permanently affordable and that we're able, it does two things. We can make that home permanently affordable and reduce the homeowner's monthly payments is by investing public, private, whatever kind of resources, just as we do when we're making a home affordable for a first-time home buyer. So for right now, pilot programs are typically tapping local subsidy sources to be able to make that investment. Um, but this type of investment and intervention should be eligible under the programs laid out by the American Rescue Plan Act. And Grounded Solutions is pursuing other potential ways to reduce the unpaid principal balance as well to really be able to stretch the type of local subsidy that we're seeing invested in these programs. Once the application has been accepted and subsidy is secured, the next step is conversion. So once again, we want to confirm that this homeowner understands the deal. And then depending on the details, there will be some kind of closing. And if you are ground leasing, you would separate the land from the improvement. Everybody will sign legal documents that both preserve the existing equity that the homeowner has accrued and set up those future resale restrictions, and then the homeowner and the home are brought into the program. From there, the programs will monitor, steward, track outcomes as usual. It's possible that these homeowners might be at risk for future distress given their history of distress, but we just don't know that at this point in time. So I think it's something that we should be watching and thinking about and perhaps planning for, but not assuming that that's going to be the case. And so here is that high level process again, just for you to see the 6 steps put together. And as a reminder, we're going to be sending out this recording and these slides, so you'll be able to have this as a resource. In talking about this process, I've talked quite a bit about the shared equity program and the homeowner, but I want to note that there are quite a few of you on this call who are perhaps not a shared equity provider and perhaps not a homeowner. So there are lots of opportunities to participate and partner to make a shared equity conversion happen. So housing counselors are critical sources for education and guidance, attorneys to help the homeowners really understand the legal documents that they'll be asked to sign and understand the deal. Lenders, because we really are, as you will see, asking lenders to modify the terms of loans to be able to reduce that monthly payment. Public and private funders both have a role to play in providing that subsidy, but also supporting the organizations implementing this kind of program. Title and closing agents who are helping to make this kind of out of the box conversion happen at the closing table. And then, of course, everybody, regardless of role, can become that trusted messenger to help distressed homeowners evaluate and make decisions. So, moving kind of from the generalized to a couple of scenarios, I thought it would be helpful to look at a few different ways that this could happen to make it more concrete. So the first scenario is a senior on fixed income. And in this case, they have no mortgage, they own their home outright, but the home has become a hazard to health and safety. If they don't take action, we're always thinking about what the alternative is, right? If they don't take action, they're most likely going to need to find another place to live, and they might lose the home entirely to tax foreclosure. So here is our list of distress types again. You've seen this list before. In this scenario, the homeowner may be experiencing multiple types of distress, but we're really focusing on that significant deferred maintenance as being the key driver. And so, matching our intervention list to the type of distress, we're going to focus on major repairs, which could look like providing a grant to the homeowner to be able to conduct the repairs, um, a grant that is typically bigger than what we see in public programs right now, or the program could step in and do the repairs on behalf of the homeowner. But either way, the primary benefit that the homeowner is getting in this scenario are those critical home returns or home repairs, and in return, they agree to come into the shared equity program. The second scenario is gentrification. So in this case, there's a homeowner who's struggling to keep up with the increasing property taxes in their neighborhood, and they're able to hold it together now, right? They're current in their mortgage, but it's slipping away, right? They're projecting a future in which they are not going to be able to keep up. The most likely alternative to this is if they don't take action would be a forced sale. And in markets like where I live in Colorado, they might not be able to find another place to buy or rent, right? So it really is a destabilizing action. In this case, the primary cause of distress is that unaffordable mortgage payment, with taxes being the primary cause of the pain. But I crossed out they are not yet in arrears, and this is critical. There, in this scenario, there is nothing that has hit the paper in terms of distress. They don't have hits on their credit report. They're not delinquent in their mortgage or tax bills. It's just really, really hard for them, and they're projecting a future where they can't continue on the path that they're on. So in this case, a refinance could be a good option for that homeowner. And we are then therefore pulling lots of levers, but especially focusing on reducing that taxation rate if possible. And because the homeowner is not yet distressed on paper, right, the hope is that they could qualify for a new loan through a refinance, and there will be an opportunity to reduce the unpaid principal balance, reduce the interest rate, adjust other terms of the loan, all resulting in a more affordable monthly payment. The final scenario is COVID forbearance. And so in this case, the homeowner has a permanent loss of income. Perhaps somebody in the family has died, or there is a new dependent that requires full time care. And so there is a permanent loss of income. And the lender's standard loss mitigation offerings are not going to provide this household enough relief to return to a place of stability. So the path that they are on is foreclosure if they don't take action. In this case, they have probably have a whole lot of distress going on, but that monthly mortgage payment being unaffordable is the primary cause. And simply what used to be manageable just isn't anymore. And so this is where we would look to pursue a loan modification. And so because the distress is now documented on paper, there are mortgage arrears, there are likely credit score hits, a refinance may no longer be possible for the homeowner, but through a loan modification, they're able to stay in their current loan. And so it doesn't trigger the same kind of review as as a refinance. And so in a modification, we are really trying to pull all the levers that we possibly can to reduce that monthly payment to a level that's sustainable for that homeowner. So I put together a fictional example to try to even make this a little bit more concrete. So in this example, our fictional homeowner currently has an unpaid principal balance of 163,000 and change. They had an interest rate when they originated the mortgage of 4.15%, a loan term of 30 years. They pay $340 a month to taxes and insurance for a total monthly housing payment of 1,311. They have been paying down their principal, and so their current equity, they're not a brand new homeowner. The current equity that they have in their home is about 86,000 and change. So if we compare that to the standard loss mitigation, right? This is what a lender may be able to offer them right now. They could offer them a reduction in the interest rate and an extension of their loan term, all of which reduces their total monthly payment going forward to $900. And so we're saying that perhaps with a shared equity conversion in which we could bring $50,000 fictionally, right, of subsidy to the table, we could reduce that unpaid principal balance further. If we could further reduce the interest rate, the loan term, if we could reduce the taxes even better. But in this scenario, with simply a reduction of the unpaid principal balance by by $50,000, we would reduce their total monthly payment to $750. So in the short term, that is what a homeowner might be evaluating. Can I keep going with $1,300? Is $900 doable for my household? Does the $750 a month feel more like what is going to bring me to a place of stability? But with resale restrictions, we have to look forward too, right? So here are just, again, a fictional example looking forward. Um, what I've done, why standard loss mitigation is highlighted in green, is I think that's what we're saying is the most likely alternative, right? They're not on a path of being able to sustain the current mortgage. That's why we're in this conversation. So now we're comparing to that standard loss mitigation that is probably the offer in front of the homeowner at the moment. And so, what we are trying to help that homeowner understand is if you pursue the shared equity conversion, yes, you will be giving up some future appreciation. Let's make some assumptions about what that could look like, but you're also going to have monthly savings. So, that total benefit, that bottom line, is the sum of those monthly savings with the appreciation. So, in this case, that homeowner might be saying, well, I'm going to walk away at the end of the day with less, but I'm having about $10,000 less total. But I have that reduction in monthly mortgage payments and that savings and trying to do that math for themselves. Of course, we, from a shared equity perspective, are also looking at it from a couple of different lenses. So the first is we want to make sure that whatever we are offering is increasing affordability for that homeowner. So we're looking at the front end ratio that new housing payment is going to be at or below 33% of their income. In this fictional example, it is. We want to make sure that we are not asking that homeowner to give up equity. And so we're looking to see if that unpaid principal balance, that new loan amount, is equal to or less than the calculated base price, right? What is going to kick off that resale formula going forward. And in this case, it is. So we're not asking that homeowner to give anything up that they've accrued to date. We also want to make sure that we are bringing something to table, right? That it is worth it, that we are creating a gap between the market and the home, the resale restricted value of the home. And so in this case, we are bringing 20% of the current market rate value of the home in the form of subsidies. So we're thinking that's a pretty good value that we're able to offer that homeowner. And then we're looking to the future, right? We have said that we can make this home affordable to the current homeowner. They can keep their equity, but is that setting up future affordability? So we're looking at that base price being affordable to a household equal to or less than 60% of the area median income. And in this case, it is. Just a quick technical side note that we can get into in the Q&A or through our help desk, but we are defining that base price as the current market value of the home less the subsidy that the program is able to bring to the table. So there are some emerging opportunities and lessons learned that I want to share quickly, and then I'm going to turn it over to you all to start telling us more about what things are looking like and what's going on in your communities. First, some opportunities. Keep your eyes and your advocacy on the federal funding. Both the Homeowner Assistance Fund, which is $10 billion, and the State and Local Fiscal Recovery Fund, which is $360 billion, could be used to support programs like this. And they can be used to support your existing shared equity homeowners too. So it's not just around market rate conversions, they can support all homeowners, including shared equity homeowners. Colleagues on the call, Matt, Jerusha, and Jason, recently issued member guidance around these funds to Grounded Solutions members, and we'll be giving a copy of that guidance to everybody on the webinar today. And they're also on the call, so if you have time to stay for the follow-up Q&A session, they can help answer questions if you have them, as much as we understand them. These are moving targets with the federal funding. And finally, my last slide, I promise. I want to highlight that anything and everything that Grounded Solutions knows at this point, we have developed in collaboration and partnership with member organizations piloting this sort of program on the ground in their cities. So here are a couple of things that we've been learning. First is that when you're working with human beings under significant stress, I should note none of these are really earth-shattering. They're pretty obvious things, but it's important to lift them up. So when you're working with humans under significant distress, one of the most important things you can do is to create the time and space that they need to be able to make good decisions. And that as much as we might want to create, and at Grounded Solutions, we do need to create some broad guidelines for programs such as this, chances are you all on the ground will want to have the freedom to treat individual cases as one-offs as much as you possibly can. So in other words, some of these things it's going to be time consuming for you and it's going to be time consuming for your homeowners. And that's something to plan for as you're building out your programs. When we're talking about distress, even when we're not talking about repairs, we are talking about repairs. They are coming up again and again and again, even when you think you have created a scenario in which that's not going to be an important factor. As we mentioned before, we think that the public investment coming from a local subsidy source is likely going to be the limiting factor for how many households can be served. And so that's why it's really important to think about all the different levers within the loan that you can possibly pull, or other ways that we can curtail or forgive some principal payment, unpaid principal balance, so that we can stretch those public funds as far as possible. I think right now where we are, it seems like that value proposition is a little bit unpredictable. Are those monthly savings enough for somebody to make the choice? In that fictional example, that $10,000 difference between the bottom line, like, is that something that people are going to choose? And we just don't know. What all data sets are telling us right now is that homeowners are acting irrationally in this pandemic. Because of course they are, right? The pandemic and everything that has happened in the past year is irrational. And so we just don't have the track record to be able to give folks some rules of thumb. It's something that we'll need to be watching and co-developing as this goes on. And finally, not to end on a downer, but there is a perception when we talk about converting a market rate homeowner to a shared equity homeowner of equity stripping. And that is not what a shared equity conversion does, full stop. But we collectively on this webinar and folks who are doing this work need to be prepared for those conversations, because I think we are asking people to think about homeownership in a fundamentally different way. And that is a hard thing to do, and it takes time, and that they are the complicated questions that we need to be working through, and just figuring out in each case how to get to the other side. So I'm going to stop there and ask you a few questions before I turn it over to Shanti for discussion. And so Baradillo, can you help me open the first poll? Which is, I'm wondering, what is causing your homeowners distress in your areas? And this, I believe, is a multiple choice question. So you could check multiple causes of distress, but but really when you think about what's going on, what's happening with your homeowners? That's the first question. One person confidently answered tax foreclosure. How about others? And if there is something that's going on in your community that is not on this list, please feel free to enter it into the chat so we can have a larger and more robust list. So yeah, maintenance is up there, unaffordable mortgage payments. I see some people moving on to the second question and the third, which is totally fine. I will read them out. What types of interventions is your program pursuing? So it looks like quite a few people are working on repairs, on loan modifications, pursuing tax abatements, and then just asking, where is your jurisdiction in this conversation? Right? Is this something that they have raised as a priority, that they're thinking about, they're talking about it? Are they putting money behind it? Are they supporting you or others in your community to do a kind of conversion program? Or some of the others. And I'm hoping folks are checking others. I'm hoping that there is some chat explanations of those too. Great. Let's see. Let's give it, I think we've been open for about almost 2 minutes. Let's give it another 30 seconds or so. It's great. It seems like there's a lot of jurisdictions that are thinking about it, that are talking about it, but perhaps are not yet on a pathway for action, which is both we need action. This is an urgent topic, and perhaps gives you all some time to be shaping those conversations and what action looks like. Okay, why don't we go ahead and close the poll? Thank you, everybody. Oh, so we can see here that deferred maintenance is the number one cause causing people the most distress. Um, and so repairs accurately are kind of the intervention of choice, and that jurisdictions are thinking and talking about distress. Great. Thank you, everybody. I'm going to pass it over to Shanti for our conversation.
Thanks, Beth. And thanks everyone for joining the conversation today. As Beth said, and as Jenny introduced me in the early part of the webinar, I'm the director of the Shared Equity Initiative at NeighborWorks America. Our Shared Equity Initiative was officially launched a few years ago in 2019, building on the work that our network was already doing in the space, and work that we'd already worked on with the Grounded Solutions Network. But we're really focused through the initiative on a range of activities that build the capacity of nonprofits to use shared equity strategies and models more readily. So in the time since the initiative was launched, we've created new training opportunities and updated training opportunities at our virtual and national training institutes. We've supported comprehensive evaluation of shared equity resident outcomes around health and well-being, and are working with Grounded Solutions team and others on developing a number of technical templates and tools for the field that will sort of be ready for folks to explore and use these models more readily. So just a little bit about the initiative. We've also made a few capacity building grants to support nonprofits that are doing shared equity work and doing sort of innovative or pilot programs that support our broader mission around this work. So we see this sort of testing and exploring of using shared equity strategy or shared equity conversions to stabilize homeowners, particularly in communities of color and for Black and Brown homeowners. It's just another way that we can kind of further our commitment to racial equity and support thriving and inclusive communities. So definitely everything that Beth has shared and the topic of this conversation today really builds and complements on our wide range of homeownership investments and housing counseling supports that NeighborWorks has had in place for a long time and has led training on. So thanks again for joining the conversation, for Grounded Solutions for leading this much needed kind of bringing together of learnings on this. So okay, so let's turn now to you all and hear a little bit from you all about what's going on in your communities and sharing some insights from the organizations who are here on the line. So I might call on Brooke Walker from the Minnesota Homeownership Center. I see that you introduced yourself in the chat. Could you come off mute and just share a little bit about what you all are seeing at the Homeownership Center in terms of the clients that you're seeing come through and how it relates to this work?
Sure, be glad to. And just acknowledge the thanks for sharing this information and having this conversation. So again, Brooke Walker from the Minnesota Homeownership Center. And I would say, I doubt that we are unlike what other major metropolitan areas and states are experiencing, but there's a lot of unknowns. And I think what we do know is daunting. We know that statewide, there are at least 51,000 households who are delinquent on their current mortgage. We know that this is up notably from pre-pandemic levels. And while we don't have the specific data, which has been hard for many to get, we agree that at least half or more following the national trend are going to be representative of BIPOC communities. And we do have data for one of our counties, which shows that about 36% of the people who are behind on their mortgage are not currently in a forbearance. And so we don't know exactly how this is going to hit. Demand for foreclosure counseling has been slow. It's starting to uptick a little bit. We do feel that the federal response is going to be helpful, but not resolve the problem by any means. And so we welcome creative solutions like these. I think whatever opportunity we have to not have a further loss of homeownership rates within communities that have historically been left out. Many of you probably know that Minnesota has one of the largest percentage gaps of Black-white homeownership rates. And I believe it's just over 50%. And our Black homeownership rate is far below the national level. And recently there was a study done by the Urban Institute, which showed in our major metropolitan Twin Cities that there was a reduction within 18 years of 10% for Black ownership. And we strongly know that this is a direct result of the foreclosure crisis during the Great Recession. And what has happened is corporations have come in and purchased properties and stripped that affordability homeownership opportunity from our community. And we're concerned that something of this nature could repeat itself, and even on a smaller scale, we believe would be detrimental to the work that we are doing in trying to close the homeownership gap. So that's a little bit about what we're seeing, and again, probably not unique, but the moratorium and the forbearances have been life-saving, but they are temporary solutions. And I think we are going to be very busy over the next 12 months or longer, trying to help homeowners figure out options and save their homes. And also just want to note too, you mentioned, Beth, in Colorado, we too have a similar experience that displaced homeowners would have a difficult time remaining in their community due to the high cost of rent. And we also have a very aggressive housing market. And I have no doubt that these homeowners are also getting several calls and outreaches a week for cash offers from investors to purchase their properties. So some of what we're seeing.
Yeah, thanks so much for sharing, Brooke. And I think as you mentioned there, I think that this is not unlike other markets that we're seeing, and definitely in terms of the conversation around Black homeownership and the gap that you're seeing there, that's certainly something that we've heard echoed in other markets. So thanks so much for sharing. I'm going to turn it over to John Edward Dallas. I know that you also introduced yourself in the chat, so I know you're here. Could you tell us a little bit about how this work is showing up in your work at Interboro?
Well, I mean, basically what we've done is we brought on to the CLT. Are you hearing me? I just want to make sure you're hearing me. Oh, good. We brought onto the CLT 2 homes that were in foreclosure. We brought on one in November and another in February. And so what we're trying to do is use the shared equity model as a homeownership preservation tool. Specifically, what we're doing is when a homeowner, what we envision is that when a homeowner has exhausted all the typical or traditional loss mitigation options, that we believe that conversion to a shared equity model could be a very viable solution. And so in the case of the two homeowners that we brought onto the CLT, they were definitely facing foreclosure. There were really no other options. There were no lenders that wanted to take their situation into consideration. And so what we did was we did an evaluation of the situation. They actually were referred to us through a legal aid society. And so they had someone to actually, advocate for them as well, or they had someone on their side that they could actually, perfectly trust, because we were new to them. And so their legal counsel was that particular party. And then what we did was we explained the model to them and explained that it would be a conversion, not just a conversion, a preservation. And then we figured out a price that was basically agreeable to them to make an equity contribution for the land. And at the same time, when we were determining that price, of course, we were looking prospectively. We were looking at future homeowners, because whatever we set as that base price, that would affect the affordability of the home to a future home buyer. So we spent a lot of time um, in that particular stage of the process, making sure that they were happy with the amount of money that we were offering them, as an equity contribution. Also, that at the same time, we were creating a pathway for home ownership for a future home buyer, lower income home buyer down the road. What we also did was we were very, very lucky to have a connection with the CDFI that's interested in being innovative and that understands the plight of homeowners who are facing foreclosure, that it isn't a matter of them being irresponsible, that they can recover, that things will get better for them, and they were willing not only to just take a chance, but to come up with a loan payment that would be able to, that was affordable to the homeowner, and that would really make them more secure in their home. So what we did was we turned our model, the shared equity model, into a preservation model, and that's our core at this point. I mean, we're interested in using it in other ways, but this is something that we've sort of cut our teeth on, and we're looking to use it again, and may have to use it again once the moratoria are lifted, and we have many homeowners that are facing foreclosure. I like to say on the other end of this, in another area that's in many cases, homeowners are facing foreclosure because of tax arrears. And so one of the things that's taking place here in the city, which I think is very exciting, is that we have a task force that is seeking to abolish our tax lien sale. And I think that that's really, I'm not sure if it's been done in other places. It probably has. I mean, a lot of it, we're not always original here in New York City. We're not always the bellwethers. But I think that that's very, very important, because so many homes, especially to African Americans here, have been lost to the tax lien sale. We have studies proving that. And it makes no sense that the city should take their debts, sell those debts to a private investor-run corporation, which in turn actually tax fees that can bring the amount, can balloon the amount to up to 65%. So when we've tackled the tax lien sale here, I believe that may be one way to reduce the foreclosure rate, especially among African Americans. And I'm sorry that I went off course here, but I just had to mention that because this tax lien sale has been devastating, and it must be stopped. I mean, imagine taking public debt, right, and selling it to a private entity that actually charges so much for the debt when it gets the debt that the homeowner can't afford it and is pushed into foreclosure. It makes no sense. It's an injustice. So we're tackling that. So, and again, sorry for going off on a tangent on that.
No apology needed.
But we're excited that we're using the shared equity model as a preservation tool. We're very excited about that as a homeownership preservation tool.
Yeah, no, thank you. Thanks for sharing, John Edward, on both
Thank you, and
accounts.
thank you too.
a good picture across, across both. And and congratulations on the 2 homeowners that you were able to assist. I'm sure that there will be many more.
Thank you.
So
Thank you so much.
yeah. Well, on that note, I might turn to Leslie Ackerman, who's also on the line. Leslie's with the Ithaca NHS, part of the NeighborWorks Shared Equity Program. So Leslie, thanks for being here. And maybe you could share a little bit about what you all are learning and seeing in Ithaca.
Sure, thanks. Hi, Shanti. Hi, Beth. Hi, everybody. So Ithaca Neighborhood Housing Services received a grant from NeighborWorks. Thank you, Shanti. And thank you, Beth, for the ongoing consultation. We received a grant for a pilot of an opt-in, what we're calling an opt-in program, or a conversion, as Beth's been referring to them in this webinar. And we've been, for the last 6 or 8 months, working on the structure of our program, trying to figure out how we're going to do basically what John and his team have already done in a couple examples. We had the questions of how is it going to work financially? Did we want to pinpoint a maximum investment we could put into each property, or was that going to be something that would depend on the property and the condition and situation that the individual homeowner was in? What kind of legal issues or other sort of administrative things did we need to figure out to make these transactions happen? But then sort of the biggest question is, how do we find a homeowner and evaluate whether they're a good fit for this? Beth's been working with us on a financial tool to do what she made an example of in the presentation, to look at some side-by-side scenarios. And we're now talking with a couple of homeowners to try to evaluate what Beth showed us, right? Here's the situation they're in now, and that's not sustainable for X, Y, or Z reason. Here are a couple of options, one of it which would be opting into our housing trust, or converting, as we've been calling it today. And what would those look like financially? In the short term, does it save them in their monthly outflow? And in the long term, do they come out ahead or behind in one scenario versus the other? One nice thing that we have in our county, and FYI for anyone who doesn't know, Ithaca is in upstate New York, pretty much in the middle of the state. It's a small town, 100,000 in the county. Cornell University is here, and it's the financial driver of the county. And some surrounding counties, frankly. And in this town, we have what would seem like affordable prices to folks in major metro areas, but home prices that are really out of whack compared to, relative to local earning capacity. And so we find that people, even at median, even above median, you could be at 120% of median, and you can't afford to buy a home. And you might not be able to afford to rent an adequate home either. So we see that combined with the lack of opportunity for us to construct new housing in town. And so this conversion is a great opportunity. But now we're at the position of trying to figure out who fits, how do we reach out? We don't want to just post, advertisements saying, looking for people who want to sell us their land and you'll get to keep your house. That, that's going to raise some of those flags that Beth mentioned, with this fear of the equity stripping, or this is fraudulent, or this is a scam and somehow I'm going to get taken for a ride. So we're treading really delicately as we look for potential homeowners. And as I mentioned, we're talking with 2 right now. One of them, quite honestly, financially doesn't make any sense. We're trying to do the math and run through it anyway to see, but it's a homeowner who's got no mortgage, but her house is literally ready to fall in on her. She has no ability to fix it herself, but it's really going to cost quite a lot more than makes sense to put into the property because it's so small and isn't going to be a high value home anyway. It's also not clear that she's going to be willing to give up any future appreciation, not any, but the future appreciation that she would have. So it's not looking like it makes a lot of sense, but as a sort of test case, it might be useful for us anyway. How would this work, even if it's not one that would be replicable at any kind of scale? The other household is also a situation where they have a fair amount of deferred maintenance, and they have a totally different financial situation from the other homeowner. They've owned their home for a while and have a little bit of equity built up, but we don't think that they're going to be losing a lot of equity by the future limitation. So that one seems a little bit more promising. And we're basically at the stage of needing to crunch some numbers and see if we can take either of these forward. The one last thing I'll add is that we have the advantage, I think I was starting to say this and got a little sidetracked. We have an advantage in our county of being able to offer a significant tax advantage for the opt-ins. It's the only county in New York State that has this, but we're able to, the local tax assessor is able to assess CHT homes at the restricted resale value rather than at market value. And that could be 40% or 50% less. So that's really substantial. And that alone could be the make or break for some of the homeowners, particularly if the deferred maintenance being tackled makes their house go up in value, which would then create a new financial problem for them in terms of increasing property taxes. So juggling a lot of pieces. I really hope that we can get someone opted in or converted in the next second half of the year. And we're really psyched to keep playing with this.
Oh, thanks, Leslie. Definitely can appreciate all the layers to sort of getting that first homeowner in and the challenges there. So thanks for sharing all that detail. I guess we have another minute or two. Is there anyone else on the line who would like to share a little bit about what they're seeing with starting any of this work or conditions with stressed homeowners that they want to share before we turn it back to Beth and get to Q&A? Any other lessons or sharing that anyone wants to, or you can unmute or raise your hand. All right, well, I do see that there are quite a few questions, so maybe I will just turn it back to Beth to close and give us the next steps and get us into Q&A. So thanks so much again to John Edward and Brooke and Leslie for sharing. Beth.
Oh, sorry. I was going to pass it right over to Jenny, I think, for closeout, and then anyone who can stay for the Q&A, we will stay on the line. And I know that there are some questions in the chat box that we'll tackle.
Awesome. Well, I will try to keep it relatively short and sweet, but in terms of resources and follow-up, just like what is next? So as Beth noted, really tune into your state and local networks. As those federal funds are being allocated, your state and local networks are going to have the most nuance about what's going on. It's where you can weigh in and make sure you're advocating to get the support you need to be supporting homeowners in your portfolio or potential conversion programs like we talked about today. And then next, I'll just say to stay tuned for the recording and links. As promised, we will send those out. It is likely to be next week till we get the video processed and everything, but we want to make sure that you can review this, share this with colleagues, etc., as needed. And next, I will say, please do share your feedback. I think Baradilla will chat an evaluation form. It is very quick, but we take your feedback to heart, and we want to know what you want to hear about next, how we could continue this conversation, and then there is an opportunity for you to include your contact information and share anything out about what work you are doing, again, so that we can facilitate peer connection, support you as needed. And so on that related note, if you're not a Grounded Solutions Network member yet, I just highly encourage you to join. You will get the option to connect better with all of your members. You'll have more access to our help desk as a resource, which again, if you're pursuing this and you want to ask some questions, pick our colleagues' brains, definitely consider membership. We've got some conversations coming up on July 14th that are members only, trying to dig deeper on some of these hot topics like this one in the field. So again, encourage you to consider membership and check out our events calendar in general. We've got more webinars, we've got partner webinars, and we've got a lot of Training Institute courses. I see John Edward nodding. He's been one of our best participants lately. So I really encourage you all
I
to
love
check
it.
those things out. Thank you. Awesome. And so I do think that is it for our regular time. So we can kind of move on into extra time Q&A even a little earlier. So if anyone has that hard stop at 3 o'clock Eastern, you get maybe a couple minutes of Q&A. Beth, do you have a question already picked out that you want to start with?
I was just scrolling back through the chat, and maybe that is the best way to do it. Does that? So
Yeah.
one of the earlier ones that I see, this is actually a comment from Angelica about HOA dues, and I do want to totally echo and lift up what she's saying, that HOA dues are another element of distress. And I want to highlight that the HAF funds, the Homeowner Assistance Fund especially, you can use that money for HOA dues and condominium dues and ground lease fees. And it is a factor that we should be looking at in a conversion, but I especially just wanted to highlight the eligibility of back HOA dues as a use of federal funds there. So hold on, I'm scanning. So Nancy is pointing out this kind of like, I think echoing what her experience has been around when that financial distress is eliminating future options, right? That loan modification, I think when we think about like if distress goes like this, right, a forbearance or a refinance, you have to kind of intervene up here, but a modification, you could work with a homeowner who's a little bit farther down. And I totally echo this question of, is there something else? Is there a forgivable loan? Is there a guarantee fund? Is there like something else that we can do to partner with lenders to be able to see flexibility in the review criteria of a homeowner, right? Could we ease the credit requirements because we know that homes that are in shared equity stewardship so rarely go into default or foreclosure? Is there another way that we can, more levers that we can be pulling to increase those options? Sorry, Sophie asked, did I catch that homeowners interested in this kind of program need to income qualify with the CLT? And I would say, generally speaking, yes. And in part, that is because oftentimes the funding source brought to the table for the investment has income restrictions attached to it, right? So if you're using a local funding source that has an income cap of 80% of AMI, like de facto, your income cap for the program is 80%. We have been talking about, and I think I've been hearing interest from shared equity programs about potentially serving a wider range of incomes through a program like this, because distress is impacting such a wide range of households. But I think the bottom line for sure is going to be going back to your funding sources. I'm scanning, I'm continuing to go. Jenny, it is now 3 o'clock Eastern. Is there anything, should we just keep going with questions?
Yeah.
Okay. So Erin asked a question about, is there a potential use for this type of programming for residents to purchase public housing homes and convert to a CLT? Erin, I think your question came in while John Edward was talking. So John, I know you had mentioned that you were thinking of some other applications. I don't know if you have any insights, or others on the call might have guts, thought, reactions, anything to share.
All I can say is that's a great idea, but it's so complicated just based on how public housing works here in New York City. But I just think that if people in public housing heard you pose that question, there would be a cheer there would be or a stampede. That's all I'm going to say, and I'll leave it at that. Yeah, it's come up many, many times.
And Erin, I think just to plug our help desk, right? If you wanted to have another conversation just to brainstorm about it, either with Grounded Solutions staff or with another member, we would be happy to facilitate that or engage in that conversation. Nancy asked, have people found a good way to connect with people in financial distress? Is it a newsletter, talk to residents to hope they spread the word to others? John Edward, you answered, they find us. I think that is what I have heard quite a bit too, is I've heard a hesitancy for programs to proactively promote a shared equity conversion or an opt-in program for a couple of different reasons. One is, I think, because it is a complicated concept, like the perception of equity stripping, of somebody ending up in the headlines because somebody heard it and didn't fully understand it, is one. I think the limitation of public subsidy, right? Not wanting to put a program out there for wide application when programs aren't sure that they're going to be able to help a whole lot of people. So I think that most of programs who are piloting this are working through relationships. So working through a housing counseling agency. John Edward mentioned the legal aid attorney who was referring people, talking directly to the tax assessor. I think, Leslie, you had mentioned perhaps in Ithaca that you had a conversation with the tax assessor to just say, like, if when you're talking to people looking at records, like somebody comes up who could be a good candidate, feel free to send them our way. And then I do think there is quite a bit, as always, like when one person is stabilized, they then tell others about the opportunity. But I hear that tension between wanting to let people know that this program exists as a resource and intentionally not putting that out there. Okay, scanning. All thanks. So I think, we are now in the informal Q&A session. So if people have, a question just came in, perhaps. Things are moving. Thank you. Carrie, for people who have these programs in place, are you using lenders that you already work with on CST loans, or have you approached new lenders?
Wow, interesting.
John Edward, are you jumping in?
Well, we work with one in particular, but this is a challenge. We don't have many. I would say in the city, 4 or 5. I'm going to go out on a limb and say 4 or 5 at most. And we do speak with other institutions to try to bring them up to speed on the model. But there's a core 4 or 5, and most of those 4 or 5 are not the major banks in the city. Like, it's not Bank of America or Citibank, for whatever reason. But we do try to market the shared equity model to them.
I welcome others to jump in. I will fill the gap while perhaps somebody is unmuting. I think I have recently been sitting in on a couple of calls between programs and their state housing finance agency. One, because that is where the homeowner assistance funds are most likely to channel through, right? So you could get kind of a dual track conversation with them. And I've also been fortunate to sit in on a couple of community bank conversations. And I think one of the questions to ask if you're having a conversation with a lender, or to think about, you could be thinking about them as, do they have a portfolio of homeowners who you are trying to reach? And then I think the question there is, do they hold those loans in portfolio? Are they the lender who can make the changes to the loan terms? Or are they the conduit to the secondary market? Because not that secondary market is by any means the end of the conversation, it's just a different conversation. Or are you approaching the lender to be that refinance partner or something where maybe they are not the current holders of the loan, but you are talking to them about being the next step for a homeowner that you could bring. And so I think for the most part, the conversations that I've been a part of, it felt like engaging with lenders who are already at the table perhaps with the exception of the housing finance agencies, which are coming through that HAF fund. Whew. Title company. Oh, I'm sorry. Before I move on, was anybody, I was filling the space to see if somebody was unmuting. Did anybody unmute to chime in? Okay. Title companies are one of the barriers to doing complex transactions so far, especially with our new buyer initiated program. Are there any existing resources that could help us get title companies or underwriters on board and educated about shared equity? That is a great question. I don't have anything right now to be able to share. Maybe others do if they have developed that for their own program. But we have been, in part of our work on this program, we have been talking to programs about it, have their title agencies. And so I think we are coming up with a pretty standardized process. It's seeming like we didn't expect that, but at least at where we are now, it's feeling relatively standardized. So I think this is a great question, and I think we should think about what it would take to be able to document and produce some of these things so that you all can have those resources. Part of it is to make it seem like that you all are not out there doing something totally bizarre, right? Like this is a thing that happens, and that nobody should need to start from scratch in evaluating it, especially the title agents.
Thank you. Yeah, we've had about 6 months of trying to get title companies on board with our program, and I think we have it now, but I still feel nervous going into our first closing to see if they will follow through. So
let's I'd be happy to connect more too, to feel like if there are things that are specific to Montana that would make it, like if we could create a connection between your title agent and an experienced one, or if there's something that like across state lines makes that feel less relevant. Or
thank you. Sure.
Yeah.
Love to talk.
Oh, sorry that 6 months, that sounds painful. Any other questions?
I will encourage folks to unmute if you'd like. I know a lot of people are extending their time. Oh, someone just asked, how quickly will we get this presentation? And I am going to generously say next week. It's possible that we will get it out to you this week. It just takes a minute to get the recording downloaded and uploaded so that it is the most accessible we can make it. And I see Nancy asked a question, when would a lender not want to modify a loan? Do you have some insight to offer, Beth?
So I'm not a lender. I think there's a couple of things that are challenging for lenders. One is if you are doing ground leasing, take like that transition from a fee simple property into one in which the land and the improvement are separated can be challenging for a lender in a modification, because it is really modifying some of the like super core terms of that loan. And so needing to work through the lender about whether, again, if the loan is something that they hold in portfolio or they're selling it on the secondary market, like their ability and the pathway to make that modification might be different, I think is one. And then I would stick with that. I think it is, if we need a modification that is beyond what their current programming is, right? If you're asking for an interest rate reduction that is beyond what is currently on the table through standard modifications and things like that, the lender might need to pursue waivers or a kind of like exception to their rules. And so anytime you're going outside of the box, I think you're asking them, and we should, right? I'm not saying that that is a bad thing, but you're needing to get the lender to do something other than their business as usual. And so that might be why they might not want to do it, because it might be too hard, or given where they sit in their banking institution, it might not be something that they can push through. But I think lenders, generally speaking, do loan modifications, especially if the alternative is a short sale or foreclosure that's really expensive for them. Like they have an interest, a self-interest, a general interest in having their homeowners be successful. So I think we should assume that they're coming to the table with that perspective, and then just identify what those things are that are within their circle of control and what is extending beyond that would need a kind of customization.
Thanks. And I have one chat. Here is a question that just came through from Duffy. To build on that question, if the organization can pay off the loan, is that a possibility? And then initiating a new mortgage?
Yes, so there's a couple ways that I think about that. So in some cases, like in that scenario number one, maybe it really is that the homeowner didn't own the home free and clear. They had a very small mortgage. And so you can just pay it off and eliminate it and take the mortgage out of the equation. When somebody is doing a refinance, that actually is paying off one loan and entering into another one. And I think programs are pursuing that in two ways. One is pay off the loan and refinance into a new one. In some cases, like Elevation Community Land Trust here in Denver, they are buying the property and selling it back, like in one transaction, right? But it is actually, it is less of a refinance, and that loan is going away and this new one is happening. I think those are the ways that I have seen that. I'm not sure, Duffy, if I'm getting to your question or if there's something else there. Yeah, John Edwards saying, in our case, the CLT makes an equity contribution to the payment for the land that the homeowner uses to reduce their mortgage payment. And that's what you would do in a modification too, right? It's an equity contribution to write that down.
I think if we have one more minute, there's one question that I got directly, and that's it. How are we sizing the market? Like, do we have a sense of how many people might need this kind of help, or how could programs who are interested in offering this support start to understand the need in their community? Is there any advice there?
That is a hard question. It's a hard question because I think, as Brooke was saying, like, we just don't know. We don't know what's going to happen when these eviction moratoriums and forbearance ends. But the Mortgage Bankers Association is doing some interesting things of like overlaying what we do know about the number of people in forbearance and delinquent, and like overlaying that with census pulse data to try to get some, like, that's how they were coming up with more than half of the homeowners in default are people of color. I think in some of the conversations that I have had with individual lenders, like, they've been surprising to say, yeah, we, right off the bat, they're like, we looked at our portfolio and we have 2,200 homeowners who are in distress. Like, we need more information than that to know if they would be a likely candidate for a program like this. But I have found some lenders to be quite forthcoming with some data points that could give you a general picture. Otherwise, I think housing counseling agencies are just like fantastic in having their ears to the ground, and with at least anecdotal trends. But I think that is something that we have been struggling with too. I think everyone knows, like, at Grounded Solutions, we're trying to get to 1 million units in 10 years, and we're trying to figure out like where this sits in that strategy. And we have more questions than answers. But I think one way or the other, for the good or the bad, like, as forbearance periods end and the eviction moratoriums, like, we'll start to have a better sense of that.
Amazing, thank you. I know we saved a hard question for last, but thank you all so much for so many of you for staying for these extra 15 minutes to get some of these questions and answers. Bardillo chatted the feedback form again. Please do let us know what you think, what questions you still have. And thanks again for joining us. We will be in touch with follow-up materials really soon. Take care. Thanks again. Thanks,
Thanks,
Shanti.
everybody.
Thanks, NeighborWorks. Thanks, Beth. Thanks to our speakers and question answers.